So I've been in the region actually since 1992. I started in Albania, of all places. I spent about 7 years there. Chayton is involved more in southern Eastern Europe. We're currently raising a new fund in that area.
Morning, everyone. So I'm Lila Pateraki. We've been in the region since 2007. We started in Southeast in the beginning, so Romania, Bulgaria, and the rest of the countries in the region. And then in 2014 we moved up, so we are currently active in Poland, Hungary, Czech Republic, Romania, and Bulgaria.
My name's Gordon Black. I work with Chayton. We have, like David, been active since the mid-90s, a little bit after him, in Central Europe. We're an investment manager. We manage about $43 billion in real estate, and yeah, that's it.
Hi, I'm Robert Martin. I'm one of the founding partners at Europa Capital. We have been investing in Central Europe for 20 years. And we've done all sectors. We've been through all the cycles, so we know how it works there. And yeah, we also have some strategies in the UK at the moment, some student housing strategies, etc. But we're a pan-European fund, and I'm the head of Central Europe.
Good morning, everyone. Piotr, Mirowski. I head up the capital markets team at Colliers. I've been at the firm for 13 years. I'm also an equity partner in the Polish business. And together with my colleagues from the CEE region, I get involved in transactions across Czech Republic, Bulgaria, Romania, and other countries in the region. Thank you.
Good morning, everyone. I'm Justyna Kedzierska, representing BerlinHyp, a German mortgage bank. The main market for BerlinHyp is, of course, Germany, but we are also present in some selected foreign markets, including Poland and Czech. Personally, I've been in real estate finance for the last almost 20 years, so also observing the development of the markets.
So let's just pick up on a few of the things that Mark mentioned there. Robert, in terms of your sort of strategy when you're looking at the market, how do you know, we've seen there about the growth that there is across those markets. How do you see this in terms of influencing the CEE real estate markets that you're looking at?
Okay, well, we're focusing mostly on Poland, Hungary, Czech, and the capital cities of those countries, but also the big six in Poland. Obviously, the GDP growth is very strong in the region, and as you can see from what Mark was saying, there's a lot of investment volume going on in the region at the moment. We're very cautious at the moment in terms of what we're buying. We've sold 350 million euros worth of kit in the region over the last 6 months. Not because I've called time on the market, just because I think as a value-add investor, you should liquidate your assets when you can. Some of us who've been in the market a long time realize that if you hang on too long, you can get caught out. So we've sold and monetarized our investments. And we're nervous about a lot of the regional cities in Poland in terms of office space. I know that a lot of people are looking at those markets at the moment, especially development. But for us, I think that we're focusing really on the capital cities. Liquidity is a key factor as a value-add fund. You want to be able to get out when you can, and we've learnt last time that once liquidity starts to dry up, it's the regions that go first.
Okay, good. Interesting to pick up with you, David. Obviously, you're investing a lot also in those SEE markets. What's your sense of that? Just pick up the point about how you're seeing the markets and what you're seeing in terms of the growth that Mark was talking about in the economic cycle.
Well, yeah, I mean, I think there's a very different, there's two halves in everything that what Mark was saying. You know, there is the more mature markets, which is very much Poland, Czech Republic, etc., Hungary, and then there's the Bulgaria and Romania, and liquidity is probably one of the biggest issues that we always have to look out for. and particularly, you know, looking at your slides relating to how much has been going into these places, a lot has been going in from retail South Africans. As soon as that starts to dry up, then actually there is a real issue. And actually because of that is what we are looking at is not actually the huge large lot sizes, but actually the smaller lot sizes, where actually there's always a market, and there's a market from the region itself. And I think it's interesting, as you were saying, both, you know, from the Czech Republic and Poland, and investors both in their own countries and regional. And we see that being one of the key players moving forward, and not really relying on, for example, the big internationals, you know, buying the big lot sizes, but looking at more the smaller lot sizes. We're also very positive about Romania and Bulgaria, because actually we've been seeing a lot of the BPOs, and we've been seeing, you know, huge transactions of people like Coca-Cola taking their major office building in Sofia, and that actually helping the economies as well. So I think you have to look behind some of the figures that Mark has shown of actually what's really happening in some of these countries on a local level.
Okay, good. Lila, just picking up with you, and it's a question also that's partly come in, so I want to pick that up. We've seen there from Mark about rising wage costs, but also there's a question here about construction costs. Does that mean development is more tricky at the moment in the region? What's your sense of that between buying standing and development?
Well, development has been very strong in the region, in all the countries, I think, including Romania and Bulgaria, that was just mentioned. But I think the prices have gone up, and we've started seeing in various countries, for example, Hungary, I've seen, and I think the discussion was also in Warsaw, and I'm sure it exists in Prague, where the construction cost has gone up significantly. Rents have not followed. Yes, yields have fallen, so they have managed to pick up some of that increase in construction, but I don't know how far that can go. So it started coming to a point where it doesn't make sense to develop that much, and I think Mark mentioned in his presentation that development has gone down, or construction has gone down in the countries in the CEE region and the SCE region. And also to add to the previous comment, is one of the things we've started seeing in the region, in the Southeast Europe, which is also very positive, is actual local capital investing. So we've started seeing in Romania transactions, one closed, I think about a month ago, in Bulgaria as well, where the local investors from the countries are buying in the countries. It's still large-scale projects, so it's not necessarily the more liquid assets, but it does help also with the perception of the market when you have the local players, you know, acquiring.
Okay, good. And yeah, the question there from the audience did pick up the Warsaw point, so that's interesting. Gordon, just in terms of, I mean, you've been active in the region for a considerable period of time. I'd be interested just to pick up the point on the US Treasuries and the gap between the yield, whether that's something that you're looking at and you're bearing in mind when just from the risk perspective, and also how you see the differences, I suppose, between some of the SEE region and the CE region.
Well, the 10-year yield is the most important benchmark, you know, rate that exists. It's the risk-free rate. I found, yes, we're focusing on it. We find institutional investors very focused on it. I find it a bit ironic because we've been talking about with the slowdown in QE, or the elimination of QE in the case of the US, although they're still holding quite a large balance sheet. Everyone knew the 10-year was artificially low, as most interest rates were, most sovereign interest rates and corporate rates. And then when it actually moved to where people thought it would be, there's this, you know, massive reaction. And you would have thought that should have been priced in to some degree, but it's real and it's emotional, and I think you're seeing it in not just the real estate market, you're seeing it in equity markets all over the world right now. So it is important, there's no question about that. I think that there's a risk premium that exists in Central Europe. That's been one of the attractive things about Central Europe. I think Robert said, he's been through multiple cycles. The markets work differently in Central Europe, in part because one of the common themes you're hearing is liquidity, and I think that liquidity, it matters. And we have seen times where there just hasn't been that much liquidity, and he mentioned that they have value funds, we have value funds, and I look at the markets today, and I think our view is that you got to have patient capital in Central Europe, because I can't manufacture liquidity. You can do the best job you can as a real estate investor, execute your business plan, look to sell, and if there's no one to take you out or the pricing isn't attractive, it can smart. As far as the differences between CEE and SEE, I mean, we had bought things in Romania and Bulgaria. I think that, again, because of liquidity and also because of, we're just a little bit larger investor. I think that the small investment size in those markets makes sense. To use the local market to also help your liquidity on exit makes sense to me. But so we're more focused in, I'd say, core CEE, the larger countries of Poland, Czech, and Hungary.
Okay, good. Piotr, just a question here that's also coming in, which is about South African capital. Obviously, been very busy over times in Poland, especially, but also CEE. Question coming about what's driving that. Interestingly, next week, 8th and 9th, when we've got the CEE summit, there's a delegation of South African capital will be there in Warsaw. So if you want to ask them directly, come to Warsaw next week. But what's your sense of that? In terms of that capital, driving investment?
I think the two major drivers obviously are the macro fundamentals and also the depth of the market in terms of its size. And Poland is the 8th largest economy in the EU and really has been outperforming its peers for the last 10 years. We haven't had technically a recession for the last 25 years, and the figures for both this year are robust. We'll probably hit 5% mark in terms of GDP. There'll be a slight slowdown next year, but I think it really is those two factors, as well as the fact that fundamentally Poland, in terms of the system, it works. The liquidity is super important, but in their perspective, it's more of a long-term investment, long-term hold, which really gives a good return on an annual basis. We've seen that they've really worked hard to build up their portfolios, and I think they've accomplished that. And they've got the scale that has been required to operate in the longer term. We see that this flow is now steadying, and this capital source is starting to get replaced by other sources of money, also outside of Europe.
Okay, that's interesting. Justyna, if I can just pick up with you. One, I think let's have a little look at what the debt market, the financing market is like. Obviously, you can give a general view, but also what's happening in terms of BerlinHyp would be good. What are you lending on? What are you not lending on? But also, obviously, you're seeing investment capital coming in. Are you seeing this increase in domestic capital? And also, where it was mentioned by Mark in the Czech Republic, is that also the case in Poland, obviously, where you're based?
So we are seeing in the Polish market the CEE investors as well, domestic investors, whether it's pure Polish capital, not necessarily. This is so-called CEE capital. And we are, of course, happy to see it, just also due to the diversification of the investment market. It's always nice to see new players. Also to understand their approach, where they come from, to make a decision to invest in real estate in CEE now. As for the real estate lending market, we as BerlinHyp, we will of course concentrate on the core markets, on the prime assets. Because Poland or CEE, Poland and Czech Republic, where we are active in, are foreign markets from the overall bank's perspective. Here, what you can see in Poland, there is a very a clear diversification between the local banks. I mean, the local banks, of course, usually with foreign capital as well, but local banks being universal banks, so lending to corporate segment, private segment. So these banks will more focus on development. Development will not be of so much interest for BerlinHyp or other German lenders. We are more looking at the investment market, and as I said, more obvious projects, more obvious markets as well. Here, you have already mentioned the issue of the regional office markets in Poland. This is also a segment which we are looking at very closely. We have started lending to this sector some time ago as well. Of course, in this case, we will be much more selective than we would be in terms of Warsaw or Prague. But we are also appreciating the strong development of these sectors. Also, keeping in touch with all the companies, which contributed to this huge development. I mean, here all the BPO and shared services companies. Yeah. So.
Okay, good. Lots to pick up there. And Piotr, you want to pick up something straight away, so let's do that.
I wanted to touch on the, Justyna mentioned that basically the domestic capital is non-existent. It's true. If you look at Hungary, you've got 60% of the annual volumes being generated by local investors. I trust this will change. Obviously, as you may know, the government is working on legislation to introduce REITs. Unfortunately, the first wave of these are most likely to be residential REITs. So the commercial element will come later, but talking to the local investment managers, I think it's clear that there is a pent-up pool of capital coming from Poland that's willing to invest. It's just there are no appropriate vehicles to have the money deployed. And I think once this comes, it will really change the complexity of the market. What is also, I think, transpiring is that the government is trying to, as they have done with the banking sector to an extent, they are really working on an initiative which will allow them to buy up more real estate in Poland, to make that, to increase the share of Polish ownership, which is basically about 1% at the moment if you look at the volumes. And talking to the couple of institutions that actually have the capacity to do that, it seems that it's closer rather than further away. It will be coming.
Okay, good. It's an interesting point. I mean, we're doing a session also with EPRA actually in Warsaw next week, focused around that idea. Do you think that this is for anybody really? Do you think, like the listed market in Spain had quite a transformative effect? Do you think if there's more of a growing listed market in the CEE, that would also bring fresh capital and maybe have a similar kind of boost to the Spanish market? Or what's your sense of that? Anybody can pick that up, really.
I think it will. I think the interesting thing about it is that if you look at the Prague market or the Czech Republic, it's the yield spread between primary and secondary is much closer than it is in Poland, and in Hungary it's very close as well, and that's because Czech Republic and Hungary has local money, and local money looks on property differently from international money. They take more of a risk, and they look at things, they look at secondary buildings differently. I mean, the internationals want to buy the nice shiny buildings with 3 tenants that have just been built by Galemco or someone like that, and that's what they want. But actually, you can still make a lot of money in assets which are not like that. And the local capital is doing very well at that, and they are, I mean, we can't, I mean, as a value add fund, we're struggling to compete with the locals in Czech and Hungary. In Warsaw and Poland, we still can compete. So it's quite an interesting dynamic, and it does mean that the market, as Mark said in his presentation, that it gives a bit of stability to the markets. And I think that the big risk for Poland is that if there is a slowdown and the international money all disappears, suddenly there's no one to buy anything because there's no local capital. So it is quite an interesting factor that we have to be aware of.
I mean, an example of this is Accolade, the industrial fund in the Czech Republic, which has been receiving a lot of amount from local investors, and they will put in something like the retail investors put in for something like £75,000 each, and their fund is over 100 million. So I think these people are looking at it, and interestingly, we're fundraising at the moment, and actually we are fundraising from those markets. So rather than going off to America, we're actually going into the region itself, because the high net worths of the region understand their region and are interested to invest. And they, rather than actually just doing a direct investment themselves, they prefer it to do through a transparent FCA or a regulated fund back in the UK. So we're seeing really good traction there.
Yeah.
Yeah, just to add to that, and it will attract international capital. I mean, it's not exactly Central East Europe, but I'll mention the example of Greece. So we have about 5 REITs there. The majority of the capital that was put to those REITs is international. And you see that the market is being driven by those REITs. So we see transactions happening at yields that are at the good assets, if we're talking about commercial, at about 7.5%, which the market fundamentals do not support necessarily, but because there's the appetite of the local REITs, and those being supported by international, you have the internationals investing in Greece at those yields. So, just very quickly answering your question, I think that the REITs that will come into Poland will bring a lot of liquidity, not only from the local market, but also from the international market.
And also, just to Robert's point, I think that's absolutely correct, that when we face the downturn, then it may well be that the international capital dries up. But I think this is also probably the moment when the Polish government will introduce the commercial REIT, because one of the arguments against it at the moment is that the market is approaching a cyclical peak, and they want to make sure that the strike price upon entry is right. So I think that we'll only see them once we face the economic downturn.
Okay, good. Mark mentioned there also in the presentation some of the risk elements that should be looking at, and there's a couple of questions have also come in on risk, so I'll try and pick those up. One of those actually, maybe for you, Gordon, is that because of, I guess, looser planning in a way, that a bright new shiny building can be built, and then the tenants move from one to another, and that creates a potential risk, particularly in the Polish market. Do you see that changing? Over the period that you've been investing, is that a risk that you've sort of built into your plan? How have you worked with that situation?
Well, I think that the planning didn't exist when we started in Central Europe, frankly. And so I would say it's much better. I think that the issue with development, not to be overly controversial, is that the Central Europe developers, especially in Poland, they've been spoiled. I mean, they've had a market that has not gone into recession for 25 years, if that's the right number. I haven't tracked it that long, but I mean, we knew that through the GFC, it never went into recession. And yet, the funny thing that happens is that the developers, tenants will move for not a huge differential in rental rate. And a lot of the times the moves aren't driven by economics, they're driven by space needs and growth and a number of things that go along with that. But that market, to pick on Warsaw for a second, everyone said it's going to 20% vacant. And 3 years ago, I said it's not gonna. I think the growth is going to continue. We talked about growth earlier. Growth has been the cornerstone of what's been driving Central and Eastern Europe. And I said, no way is it going to 20. And it really, I think it's back down to almost 10 is kind of the number. And yet, the developers, because they're so ambitious, continue to offer incentives to the tenants, and they're driving the market to really act like a tenant's market. And it shouldn't be a tenant's market at 10% vacant. Maybe it was a tenant's market at 14 or 15, but you could see the absorption was consuming it. So I think there needs to be more discipline from the developers. You asked the question about the planning. I don't think the planning, there is still some kinks that you will find along the way, but I think it's much, much better. It really has to come from the developer side, and that may not happen until they get hurt.
Two things. One on what Gordon mentioned. So I think part of the incentives package, which is, yes, it's big in some of the countries, is also driven by the fact that because rents have not gone up, or nominal rents, or we kept them at a certain level, or the developers kept them at a certain level in order to make, you know, with the yields compression money, then they need to play with the incentives. So we see, I'll give the example, and that was a long time ago, but in Bucharest, where they said, oh, okay, we are maintaining rents in a very good building at 18 euros per square meter. Okay, and what was the rent freeze for that? 2.5 years of a 5-year contract? Okay, that's not 18 euros per square meter rent. So I think this is also driving the, you know, the high incentives that we see in the market. But in terms of the risk, I think one of the things that a lot of the investors have forgotten in these countries, maybe because it's easier to manage the projects from abroad, is asset management. So I think that, yes, you can have your tenants stolen and go from the developer from one building to another, but our experience shows with very strong asset management, with a lot of attention being paid to tenants, with capex being planned even in brand new buildings, by constantly improving them and improving their infrastructure, that the tenants can be sticky, because the difference between the various buildings and the offers they get, they're not that much different. So if they feel that they are in a property that they are respected, that their needs are catered for, then they won't leave that easily. So it is a problem, but I think it also has to do with the fact that, for example, in Poland, a lot of the investors were managing their projects remotely. So tenants didn't have who to talk to, and then they just left when their time came.
Okay, good. Robert, I just wanted to pick up with you. One of the, you mentioned at the beginning there that you've been selling into the market. One of the points from that is, are we in different cycles in different parts of it? Were you selling on to other new international investors or local capital, or and is there a more liquid market once you move into kind of secondary, let's say Poland? Are you then able to sell to more international capital? Who's buying, I suppose, is the question.
Well, it depends. I mean, we sold some things in Bulgaria to a Bulgarian fund, actually. So we're backed by South African money. And we sold our 2 office buildings in Warsaw to international money again, insurance companies. One insurance company and one large South African-backed investor. And we sold an office building in Prague to a local. So, you know, there is liquidity for assets if they're well priced and well leased. I think if you know, there seems to be a sort of gap in the market between opportunistic value add and very core, and there's that bit which we call sort of core plus, which is quite difficult, you know, because people don't really want to do that at the moment. They either want to take opportunistic risk and try and make lots of money because they think the market's a time to do that, or they want to buy core and hold it for 10 years and get the yield premium. So if you're in that range in between, it's quite difficult. So our job really at Europa is to take assets which we think are fundamentally strong and try and create them into institutional product for an institutional buyer to buy. That's what we see as our job, and that means that you know, you have to take risk in terms of leasing risk, sometimes title risk. I mean, I've even taken title risk sometimes. So things that the institutions won't touch, but we're prepared to deal with by going into it with our eyes open, with some sort of plan and trying to manage it out. But these days, it's really, I mean, refurbishment and releasing. And there are still assets out there which funds want to sell because they're reaching the end of their time, and you can buy good assets at good prices from motivated sellers. And although, and I'll give you an example, we've just sold an office building in Warsaw for 4.7%. Okay, so it's a record yield in Warsaw. You can go into one of the submarkets in Warsaw and buy something for 9%, fully leased. So there's a huge divergence of yields in Warsaw, and Warsaw has become a very, very micro market these days. You've got to be very careful about where you buy. You know, they even call a section of Warsaw Mordor, based on the Lord of the Rings bad place. Yeah, so I mean, it's quite odd. So I mean, but deals are starting to happen even in Mordor nowadays. So why you'd want to go there, I don't know, but maybe that's what you can do. And so there's a huge dichotomy of yields. There's a huge dichotomy of rents. There's a huge dichotomy of occupiers, and you have to choose very carefully where you want to make your play. And I don't think that's the same in the regional cities in Poland yet. I mean, Piotr may have a different view, but I think the regional cities are small enough. I mean, the reason that I don't particularly like offices in the regional cities is because a developer builds 2 big buildings and suddenly they're oversupplied. You know, they're tiny, immature markets. And what I was talking about earlier, you know, the developer will come and he'll suck out your tenant, and suddenly after, you know, you've got a 5-year lease, and after 5 years the tenant will leave, so you've got a vacant building. So you've got to be very careful what you're doing.
Piotr, did you want to pick up on that?
Yeah, I would definitely say that the liquidity in regional markets comes in waves, and we've seen what happened last year. It was a record year for transactions in regional cities outside of Warsaw, and this year it's quite the opposite. It seems that timing really is everything if you look at the regional cities. But as opposed to Warsaw, even though the yield spread is quite attractive, it can be 300, 400 basis points in certain instances, but for sure the amount of capital is much lower, but still it is changing, because for some of the new money that comes out from outside of Europe, the yield profile is actually quite interesting. That's why they look at regional cities. But I would totally agree that Warsaw really is the driver. And what I like about the changes in the market is that it really gets deep. And Robert spoke about the dichotomy. But I think the liquidity in Warsaw is at its best point ever. And if there is a willing seller, then the transaction will happen. We see that. We see it on the core side with the deals that we've seen. But at the same time, if you look at the transaction that Robert did, the pricing per square meter there was probably close to 7,000 euros. And on the other side of the scale, you've got deals happening for well below replacement cost at 1,200–1,300 euros per square meter of GLA. It's a huge gap. But the market is in general animated and liquid.
Okay, good. I just wanted to pick up on one thing, just in terms of you mentioned that there was more appetite for lending. We've had a question in about the overall volume of lending. Is more being allocated, do you think, next year in terms of loans? Have you got potential to lend more into the market next year? What's your sense of that?
Yeah, because of course it will very much depend on the bank's approach, strategy, also the size of the bank's portfolio. Currently, our Polish portfolio is around 2 billion euro, and we feel fully comfortable with this. So I believe that taking into consideration the total loan portfolio of BerlinHyp, we will not be interested to increase this portfolio. Last months we were while working on syndicating on certain transactions from our portfolio, and we were successful in it. So we will definitely continue to lend. Yeah, again, as I mentioned before, on a selective basis for best properties, best locations. Yes.
Okay, good. I want to pick up on some of the sectors now, if we can. So let's start with office. I also want to pick up a question that's come in related to that, which is obviously a lot of the growth, particularly in Poland, has come through the BPO sector. If we're seeing the sort of high wage growth that Mark was talking about, and issues with unemployment and therefore growth coming through from that point of view, is that going to slow the growth of that sort of BPO style sector for office?
You have to remember that we're coming from very low bases here in terms of wages and wage growth. You know, if you look at somewhere like Bulgaria or Romania, I mean, you're talking about 400 euros a month as an average salary. So actually, increasing by 10% isn't actually a great amount of money. So I think there is still in these countries particularly, there is good workforce, intelligent, English-speaking, and therefore, you know, these companies are going there. They're also being encouraged behind the scenes by the European Union to actually be in Europe rather than be in Asia. So rather than actually putting your call center in China or India, actually to move it into the regions. And therefore that is actually contributing to this demand.
Yeah, I think there's a lot of legs for the outsourcing sectors. And I think that it's not just about cost. I think if you try to compete and be the low-cost provider in outsourcing, you know, you don't have a value proposition. I think the value proposition is what David said. I think you have a highly educated, well-trained English-speaking community, and anybody who's been on the phone with, you know, whoever you want to say, Vodafone, and you end up in a country, India as an example, the English isn't good, the problem solving is frustrating. And so I think that it's cost effective, but I think longer term it's going to be because I think you have quality value proposition. And so I think that has a long way to run in Central Europe.
But do you think there's any danger, I mean you mentioned their call centers, do you think there's any danger as AI gets more proficient that may affect that kind of market?
Well, I don't think it's just call centers. Again, I think the proposition's broader than that, and I think it's a higher value proposition on the food chain. So, for instance, we owned a very large office building in Budapest. Morgan Stanley was doing all of their back office, paperwork and what have you for their trading activity, and there are more things going on than just the call center. So I didn't want to limit it to my comment to that. It's
sure.
Much broader. And accounting services or, you know, other consulting services. It's significant.
And another important bit here is in terms of internet speeds. You know, if you look at Romania and Bulgaria, it has the fastest internet speed in the EU. And therefore that also contributes to these people coming. It will also contribute to the whole idea in terms of e-commerce as well, because these are very IT literate people with very good with very good internet speed, and that will also assist.
Okay, good. Let's pick up on the logistics because that seemed to be a winner both ways. You've also got the new Silk Road coming through. Straight through CEE, up through Athens and straight through. How much potential growth do you see? I mean, that's interesting that you pick up the point about the fast broadband speed there and the take-up of that. What's your sense of that? Is it all sunny skies for logistics? Can't lose?
I think generally, yes. I mean, I think there's a very good demand case here. We were in Zagreb last week. Croatia literally has about 1 or 2 big logistics boxes, and there's a great, there's a great need in the country for that. I think, as we said, in terms of retail changing, I think there is going to be continued demand, and therefore there needs to be supply of this.
Yeah, it seems that the logistics wave is continuing, and everyone's very excited about it still, and the developers have become very, very professional. I mean, Panettone, Prologis, P3, all these guys are very, very good at what they do, and they just churn these things out. And when I started my career, I was leasing boxes in Park Royal 20 years ago in northwest London, and leasing them at £4 a square foot. And you go up there now, and they're still at £4 a square foot. So it's a market which is interesting in that there's no real rental growth because they are ubiquitous. I think it's going to change now because of this. There's a whole structural change going on with logistics, especially in urban logistics. But generally, it's not, you know, tenants aren't particularly loyal to your building. You know, they can, you know, Panettone can build a shed and lease it to someone, and then they'll sell it to you, and then 5 years later they'll build another one, and they'll take your tenant. So it's similar to what I was saying about offices. So it's not a particularly loyal business, and it's very ubiquitous. And Poland is very flat, so you can build things everywhere. I think it's different in Prague, which is not so flat, and it's different in Budapest, which is a different market as well. But Poland logistics at the moment is very, very hot. You're dealing with professional people. It's quite difficult to make money out of it. And if you're a core investor, yeah, you can still, I mean, you buy it for the yield, I guess, and run on it. But yeah, we'll have to see what the cycle does with terms of when all the tenants' leases come to an end.
Okay, good. Retail, does anybody want to pick up retail? I mean, interesting that Mark mentions there that there should be a good potential for growth even if e-commerce picks up, and it doesn't appear to be suffering, at least from the sort of catching a cold from the US that maybe the UK or others are. What's your sense of that, Piotr?
Well, I think as Mark shown on the slide, I think we still have quite a long way to go before we can get concerned. From looking at the portfolios that are out there on the Polish market and the landlords, they seem to be performing well at the moment. Obviously, they are thinking ahead, and clearly the whole industry is going into a new direction. But I think, judging just by the numbers, it seems to be still quite stable. Even though on the investment side, I expect there'll be less liquidity. Those portfolios that have been built up, I think that the landlords will have to really work hard on them to keep them going. And at the same time, it seems to me that the inflow of new money looking specifically for retail is shrinking.
I'm happy to add on to that. I mean, we've owned a lot of shopping centers in Central Europe, something like, I don't know, high 20s, almost 30. And you've seen this kind of, you know, first generation, second generation, third generation. You've seen that evolve with the increase in wages and consumer spending, and it was needed. And then I think that people felt you could build a shopping center anywhere and it would work. And so the retail markets are not in a good place right now. There may be an overreaction. I remember back in the 80s, it was headlines, you know, retail shopping centers dead. You know, early 90s, it's going to die. I don't think that shopping will ever go away. You know, again, not to be controversial, but yes, the increase in e-commerce is going to happen in Central Europe. But there's some people, maybe it'll wane, but I don't think so. I think some people like to go to a shopping center. They like the leisure and the entertainment. They like to touch the goods. But frankly, they built too much retail. And in a number of places, they built too much retail. So there's some shopping centers that are going to go by the wayside. And right now, you know, in terms of institutional money around the world, people really don't want to buy it because there's just too many unknowns. So I would say the amount of money that's out there interested in retail, it's definitely reducing, you know, every day. It's significantly down in places like the UK and the US. And I think that, you know, you had, you know, a lot of the South Africans buying really big shopping centers, which is fine. They had different motivations for a number of reasons. And I'm not saying they were wrong, but if you took that out of the market in Central Europe, retail volumes would have been way down.
Okay, good. Let's pick up a little bit on leisure hotels. Obviously thought about as an SEE play quite a lot, simply because of weather and other things. But what's the sense of leisure? I know that Europa have bought hotels. What's the sense of that? Anybody want to pick up that?
Yeah, so I quite like the hotel market. I think generally in Europe the hotel market is going through a bit of a boom, I suppose like every other asset class. But I think that that's because of a structural change in that there is a lot more tourism these days. You do get a lot more people going on trips, and they like to stay in hotels. And the hotel market is maturing and changing. In Central Europe, we have a hotel in Warsaw. Now, Warsaw is a business city. I mean, it's becoming a bit more leisure, but it's a business city. That means you basically get 4 nights of the week, which you can rely on. which is a 55% occupancy. And if you can buy a hotel which has got more than that as a track record, then that's a well-performing hotel in my opinion. I won't go to resort hotels because they're just too seasonal, and you have to try and make money all year round, not just for 4 months of the year. But I do believe in the hotel market. It's undersupplied. Gordon will, I'm sure, tell you that if you go and try and stay in a hotel in Budapest, Prague, or Warsaw these days, you're paying a much higher price than you used to pay. I mean, I nearly had to pay 400 euros for a night in Budapest the other week. I mean, so whereas you can usually get a room for 125. So it is a changing market, and there is a supply need. Of course, you've got to be careful what you build and where you build, of course. But I like the hotel market at the moment. Okay, good. Anything for you, David, in SEE? Are you interested in that market or not really?
No, I mean, we are working with a hotelier who was, we were looking for him potentially at setting up a chain across the region on business hotels. We do see there a real demand there, but we haven't really fully taken it forward.
Okay, good. One of the other interesting points from Mark, I thought, was that if you look to UK and Germany, there was sort of 26% were in what might have been regarded as alternatives. So student housing within that residential kind of part, micro living, senior housing. What's your sense of that? I know, Gordon, you've been quite active in the residential markets there. What's your sense of that, and anybody else, in terms of those kinds of alternatives, whether that's senior living, student housing, but the broader residential?
We are very, very active in what we call living, so it encompasses all three of those things: senior housing, student housing, and just for rent residential. In Central Europe, the home ownership levels are very high because of the history. People basically were provided from the government homes after the fall of communism. But it's changing, there's no question about that. We built a lot of for-sale condos in Central Europe, and that's what the developers were doing, because they jumped right past the for-rent market because they could make more money doing the for-sale. So we're keen on that market. The senior housing market, very different. It's driven by wealth, it's driven by culture, it's driven by a number of factors that I think it's too early for that in Central Europe. In my opinion, I think that most Polish people would say you better take care of your parents when they're old, and that takes time to change. The student housing market, completely different than that. You have a number of universities, and you have not a lot of options, although there are a number of people who are going to school close to home, and they stay at home. I think that market will evolve. I think the residential for rent market is evolving. Some of the stuff that we built in Krakow with Heinz, we had developed a large residential for sale project, and we sold the last phase to a buyer who was renting it, the entirety of the final block. So it's happening, and as an investor outside of the region, or an international investor, the one thing that is tricky is you're really taking FX risk in the for rent markets, and I think that'll put some restrictions on the market in terms of capital flows. Okay, good.
And I think one more thing is, we've seen the alternative investments get a large part of the play, but mostly in liquid markets, so in markets that have been tested. So you see it here, you see it in Germany, but maybe Spain, but I don't think that international investors are ready to take the liquidity risk of an alternative investment in the region. So I think as Gordon said, I think it's early. We have seen I think the only thing that really exists is the residential for rent. And we've seen that maybe not so much, although it has started at the institutional level, as more as local capital, getting large units to rent and have an income for its kids or whatever. But that is slowly changing, and I think there is institutional capital that is coming. But I think the rest is early for this cycle. So probably in the next one, when it has proven its liquidity in the core markets, then I think it will start moving to the region.
Yeah, I have to say we're quite positive in the market disruptors, both in terms of residential, but also in terms of flexible offices as well. I remember that I think the last thing I was here, there was a comment that there's 891 flexible office centres in London. In Bucharest, there's actually 5. So I think there's a change. But one of the things in terms of the residential market disruptor is about financing. Getting finance for build to rent and rental buildings as well as flexible office buildings is much more difficult from the banks, because they don't look at it in the same way. They don't see the income as secure. You know, it's as difficult here in the UK, even trying to get a bank, you know, with a good rate of interest to actually lend. But it's even more difficult when you actually go to southern or Central Eastern Europe to actually getting lending for this type of investments. So that will limit.
Which is QU, Justyna.
Yeah. Well, which is obviously because the banks do not have any experience in those markets. In Poland, there is one, and the very first bank loan signed like a month or 2 months ago for Resi for Rent scheme. I know that the loan negotiations took like about 6 months, so it already shows how much, unusual type of a product it still is for any bank. And this loan was, of course, provided by one of the local banks, being more closer to the market, more familiar with the specifics of the Polish behaviors, let's say, being able to assess the potential of the project. Yeah, cash flow.
Okay, good. I wanted to pick up, because we're nearly at the end of our time. We've gone slightly over, but allow me. Just in terms of the risk, obviously, political risk, there's arguments with the European Union, there's various things. How do we see that? Is it influencing investors' views, or are they just accepting that as political risk, and there's political risk everywhere else in the world? How are you seeing that as investors?
Well, political risk does indeed be relative, but I think that at the moment the Poland and the European Union are having a little bit of a fight about the independence of the Supreme Court in Poland. And there are 2 factors. First of all is that they're having a fight, and usually when they have a fight, what we've experienced is the exchange rate fluctuates rather badly, which isn't good for anyone who has tenants or customers that take payment in Polish zlotys. So that's the effect of that. But I think the underlying cause of this fight is that the independence of the courts is pretty serious. I mean, you know, one of the first things that you do when you make an investment into a country is make sure that there's a rule of law and a standard rule of law. So I think a lot of the German investors are worried about this. Some people clearly aren't, as we've seen from the amount of investment going into the country. And we'll just have to see how that pans out. But the other issue which the politicians are fiddling around with is taxes. And I think predictability of taxes is another premise of doing any investment in any country. And you know, I don't know if you guys know, but there's been this huge sort of fight about VAT recently. So you buy a £100 million building, you pay 22% VAT, so that's 22 million. And most of us expect you'd get that back after 6 months. So suddenly, about 2 years ago, the Polish government decided they weren't going to do that. So suddenly you don't get your 22 million back. And that's obviously a huge issue, because that's all your profit gone. So that I think is now resolved. Piotr, it's getting resolved. I mean, they're getting there. But you know, it's that sort of change to things that you think you know what's going to happen as an investor is not positive. So I think that, I mean, you know, we'll have to see what happens, but I think the political risk is definitely a factor.
One interesting thing is when you actually think of the yield gap between, for example, Warsaw and Bucharest, and you look at this being for offices, you know, 4.5, I think you said, compared to Bucharest, which is 7.25. If you factor in political risk, that yield gap still isn't, it takes into account far more than that. And I think for us, I don't think it's as much political risk in terms of our region. I think it's more just negative perception because of the hangover from what happened in the past and the losses that people made in the past and the war stories from the past. And I think that is what is stopping basically international investment coming in. And it's why it is that we have a real thin in our region. It's a real thin liquidity that we're always fighting against, which is why we won't look at the big investments. We will look at the smaller stuff where there's good income flow and there's a good exit always.
Well, I'm usually the pessimistic one in panels, but this time I will be the optimistic one, saying that yes, there is political risk, but isn't it around the world these days? So I think based on what is going on with the rest of the world, CEE is no different. So it's not more risky than what UK is these days or US is these days. So yes, there are issues, and there have been some controversial things in Poland, as Robert mentioned, but I think you can work around them, or most of them. And I know, for example, that 4 or 5 years ago, when we were trying to pitch Hungary for our investors, it took us a long time to convince them that, Orban wasn't this very bad guy that would destroy everything in the country, will disappear in a year. But we see today that, for example, when we were pitching the Polish deal, it went in very smoothly. So I think it's the perception of risk that has changed. CEE is a new region, so it attracts attention and people are not familiar with it. So we're more ready to forgive UK or US for things that might happen, but we're not ready to forgive Romania or Poland or Hungary because it's a new place and we don't know enough about it. But I think that, as I said, it's no different than the rest of the world, so I don't see that as a problem.
Okay, good. I want to leave enough time for networking and private questions that you've got as well. So I just want to finish on my normal one, which is about investment. So let's try and boil down everything that we've said today and what that means in terms of investment and opportunities. I'd also like to say that so far, and I'll wait until we get to the end of this. Let's start with you, Justyna. So based on what we're seeing in the market, what you can either judge whether this would be where you would lend or where you would invest, but where do you see the opportunities based on what you're seeing in the market at the moment? We'll start with you. You get longer to think, David, at the end there. Justyna.
So we as a lender are following our clients, obviously, trying to understand the rationale to invest in this or another segment, market segment. I think that in the next months we will see more and more huge logistic portfolios presented to the banks for refinancing. This is what is happening already. So all the investors which were acquiring logistic properties, which are usually rather smaller in several locations, they are right now trying to make out of it a nice portfolio, to have certain advantages to refinance. Yes, so this is what I'm expecting to see in the next months. I also do believe that the development of regional office markets will continue. Again, I also think it has a future, and I believe it's worth to be observing this market, to be there, and to understand again the rationale of investors coming to Poland, moving their activities to Poland or expanding in Poland. As for retail, as the other speakers already said, I also do not expect to see here much investment interest, but what we are seeing already now are refurbishments, redevelopments, extensions happening in nice shopping centers that are already existing in the market. Yeah, and that's it.
Good. Piotr.
Before I just give you my feeling, I just wanted to relate for a second. Being Polish, I feel compelled to maybe give you a brief update of what's going on the political side in Poland, because it's dynamic. I think finally, and I know that there is, there is a bit of concern about Poland. I think finally we've come to a point where the tide is turning. The local, the municipal elections, which took place a couple of weeks ago, have shown that the governing party cannot go beyond a certain threshold in terms of support. And I think this is probably they have peaked out. One thing is for sure, that Poles are in favor of the European Union, and I think one of the reasons why they didn't really hit the target in terms of the elections is because a couple of days before, some of the key ministers in the government actually wanted to question the sense of functioning within the EU, and it didn't go down well with the electorate. So I think it's one thing. On the tax issues that Robert mentioned, it's true. The situation seems to be calming down at the moment. One thing is for sure: this government will continue to clamp down on any tax optimization schemes. I think this we can be certain of. In the other areas, I think it'll be more stable going forward. And on my pick for investment in Poland, I think, having taken into consideration what Robert said about regional cities, I would still argue that there are certain instances where you can make the right pick. I think there are a couple of locations within Poland that are not yet fully priced in, and obviously it's all about timing. But I feel some cities that it's difficult to justify the yield gap in comparison to the two most established markets outside of Warsaw, which is Wrocław and Krakow. They are for sure fully priced in, but I feel there are still a few big regional cities in Poland that I would definitely take a look at investing.
Great, Robert.
Okay, well, I've already disclosed that I quite like the hotel sector, and I think if you can buy a good hotel which needs to be refurbished and redone, I think that's in a good location in the city centre of one of the capital cities. I think that's a good pick at the moment. And I quite like Hungarian offices, or Budapest offices, should I say. I mean, there is rental growth. There's huge rental growth there at the moment. You have a vacant building and you lease it in a few months, it seems. So that seems quite an attractive. So rents are going up and yields are going down, which is a rare thing that's happening in Budapest at the moment, and that's quite an attractive story.
Great, Gordon.
I guess probably two things. One, Robert had mentioned the spread in some of the office sectors where you have kind of a prime core yield, and then you have numbers that are all over the place. So if you can identify property with good bones that's been neglected, again with patient capital, I think that's an area to focus on and work the assets and strong asset management. And the other thing is, even though I am, and I think most people are troubled with retail, it can turn into an opportunity. So if it gets oversold, there's winners and losers in retail. So you just got to be able to, hopefully pick the right ones, and at some point it'll be a buying opportunity.
Great, Lila.
Well, we do believe in offices, so also just offices, and I'll go to the core plus value add segment. So there is opportunity there. I'll say in terms of countries or cities, I'm more in favor of capital cities. We don't feel so strong about regional cities. I believe they haven't proved their liquidity yet. So that's a question mark, but in terms of capitals, I would say definitely all of the CEE, maybe with the exception of Prague, which has become quite expensive in all the sectors, even within or in all the submarkets of the office, let's say.
David.
We really believe in our area, which is Southern Eastern Europe. We think that the yield gap is too big in various sectors compared to some of the more established markets of Poland and Czech Republic. We think that the economies are in a very, very good position. Banks are being very ready to lend on normal product. as well as at the lower ends. I think there is real opportunities in the market disruptors, as I mentioned. I think also in residential, there is still a lot of residential that needs to be built. And I think also even in terms of retail, I think there are good opportunities to be had, perhaps more in the smaller size malls in the smaller cities rather than just the big shopping centres. But for us, it's always about looking at things where there is liquidity and income, and if they're there, then I think that's positive.
Thank you.